As a business owner or prospective business owner, are you aware of the most tax-efficient ways to pay yourself from your limited company? Stay tuned to find out. Hi there, Chloe Zaytunian here from Rapid Formations, the UK's leading company formation agent. Whilst sole traders generally pay themselves directly out of any business profits, there are more options available to the owners of limited companies. This creates greater opportunities for tax efficiency and planning. As well as being able to pay themselves like employees through PAYE, company shareholders, who may also be the sole director and owner, particularly in smaller companies, can also draw dividends. Furthermore, directors' loans are available, as are a variety of employee expenses, all of which can go towards an overall package of benefits. In this video, we will look at these options for paying yourself from a limited company below. So let's get started with taking a salary from a limited company. SME owners will often be directors as well as employees. Just like any other employee, company directors can draw a monthly salary through HMRC's Pay-As-You-Earn or PAYE system. Salaries are counted as allowable business expenses, so the payment of salaries has the effect of reducing the amount of corporation tax payable on company profits. However, paying a high salary can be less tax efficient than drawing dividends. We will discuss this in more detail shortly. If they have not already done so, company directors must register as an employer with HM Revenue and Customs to draw a salary. This is the case even if there is just a single director who also runs the company. PAYE registration should generally take place before the first payment, and not more than 2 months before this first payment. To process any salary payments before an employer PAYE reference number has been obtained, it is necessary to 1. Run payroll. 2. Store a full payment submission. 3. Send a late full payment submission to HMRC. Limited companies with between 1 and 9 directors can register for PAYE online. At Rapid Formations, we include PAYE registration with our all-inclusive package, or it can be added to any other company formation package as an additional service on the checkout page. Salaried directors will be taxed at source through the PAYE system, just like any other employee. Income tax and national insurance contributions, or NICs, must be deducted, along with additional employers' NICs, and paid to HMRC. For tax efficiency, some directors opt to limit their salaries to the NIC primary threshold and tax-free personal allowance, both of which are £12,570 for the 2024-25 tax year, and then draw further payments via dividends. The latest national insurance rates for employees and employers are available online, along with income tax rates for England, Wales, Northern Ireland and Scotland for the 2024-25 tax year. Next, let's look at how to claim expenses and benefits from a limited company. Some business owners will decide to make substantial use of expenses and benefits in addition to taking a salary and dividends. There are a whole variety of expenses and benefits which may be claimed by company directors, including but not limited to pension and retirement benefit schemes, computers and office equipment, training costs, company cars, fuel expenses and parking charges, medical insurance, travel expenses, meals and entertainment costs, and childcare. There are different taxation and reporting rules depending on the type of expense. A full list of expenses and benefits, along with the relevant tax rules and rates, can be viewed at gov.uk's Expenses and Benefits A to Z, and we have included a link to this page in the description below. Each type of expense or benefit is subject to a different amount of tax, and some are tax-free, for example, certain childcare expenses. Taxes on employee benefits should be reported to HMRC where necessary and paid accordingly under PAYE. Taxes on expenses can be paid as part of the PAYE system on a monthly basis together with the payment of salaries. Additionally, employers must send HMRC details of any expenses and benefits which have been provided to employees or company directors, including their family or household, in the form of an end-of-year expenses and benefits report. Form P11D needs to be filed for each director or relevant employee who has received expenses or benefits, and it can be completed and submitted online. This must be done by the 6th of July following the end of each tax year. For more information on completing Form P11D, we have included a link below to Gov.UK's guide, How to Complete Forms P11D and P11DB. Full records of any benefits and expenses paid to directors and employees must be retained for 3 years from the end of the tax year to which they relate. HMRC may request to see these records as part of an inspection. Records retained should include the date and details of every expense or benefit which has been provided, any information needed to work out the amounts which appeared on end-of-year P11D forms, and any payment contributed by directors or employees to an expense or benefit. Any correspondence with HMRC in relation to benefits and expenses should also be retained. Now, let's move on to drawing dividends from a limited company. SMEs often have a single shareholder who also acts as sole director and who essentially owns and controls the entire company. In this scenario, or where there are just a small number of company owners with equal rights, it will often be more tax efficient to pay out dividends as opposed to full salaries via PAYE, although a combination of the two can be most effective. A dividend is essentially a payment made to company shareholders out of profits. They generally need to be made equally to all shareholders based on the proportion of shares held. Dividend payments cannot exceed company profits from the current and previous financial years. A directors' meeting must be held to declare the dividend payment, and minutes of the meeting must be retained, even in the case of a sole director. In respect of each dividend payment made, a dividend voucher must be written up and include the company name, the date of dividend payment, the names of shareholders being paid a dividend, and the total amount of dividend being paid out. Copies of this voucher must be given to each recipient and retained for company records. There is no corporation tax levied on dividend payments. However, they do not count as business expenses and therefore cannot be deducted from the corporation tax bill. Shareholders who receive dividend payments are liable to pay tax on any dividend income above £500, which is the tax-free allowance, received in 2024-25. The rate of tax will depend on the individual's income tax bracket. However, the tax rate applied to dividend payments is lower than that for salary payments. The current tax rates applied to salary payments are 20%, 40% and 45% for basic, higher and additional rate tax, respectively, whereas dividend tax rates are 8.75%, 33.75% and 39.35% for basic, higher and additional rate tax. So far, we have covered salary, expenses and dividends. Now, let's discuss directors' loans. Unlike sole traders, whose personal and business finances are generally fluid and interchangeable, limited companies must follow a strict process when money is taken out of the business by an owner-director. Other than through salary, expenses or dividend payments, one method of making business funds available for personal use is via a director's loan. A director's loan is not considered to be a payment in the same way as salary or dividends, but it is crucial that accurate records are retained, as director's loans are subject to their own tax rules. These records are known as a director's loan account. At the end of each financial year, any money owed to the company as part of the director's loan account must be included in the balance sheet as part of the annual accounts. Taxes which apply to director's loans comprise Section 455 Corporation Tax at 33.75%, if the loan is over £10,000 and is not repaid within 9 months at the end of the relevant corporation tax accounting period. And personal tax, if the director's loan is over £10,000. If any asset belonging to the business is used by a company director for their own personal use, this is known as a benefit in kind and must be declared for tax purposes. Should a director's loan account exceed £10,000, it will automatically be classed as a benefit in kind and needs to be reported on the director's self-assessment tax return. Although corporation tax is generally payable on directors' loans, this can be avoided through tax relief if it is repaid within 9 months of the end of the relevant corporation tax accounting period. However, the amount still needs to be declared. If a director's loan is repaid within the 9-month period, but is immediately taken out again, this is known as bed and breakfasting. HMRC will view this as an attempt to circumvent tax and will deny tax relief in respect of any loans over £5,000, which are repaid and then taken out again within 30 days. So there you have it. We've covered the various ways to take money out of a limited company, including salary, expenses, dividends, and directors' loans. We hope you found this video helpful. If you have any questions, please leave them in the comment section and we'll get straight back to you. In the meantime, we have included several useful links in the description below. Finally, be sure to subscribe to our channel to get more tips and advice on limited companies, reporting requirements, tax obligations, and more. We're always happy to help and we can't wait to hear from you. Thanks for watching. See you next time.